Welcome to SF Commercial Property Conversations with Bruce Bean, where Bay Area investments meet expert insights. Get ready to unlock the strategies of commercial real estate success.
So today we have Robert Preston with us, and Robert comes out of the Marine Corps flying Ospreys and is into owning trailer parks now, or RV parks. So Robert, great to have you. I just love to hear kind of how you got from here to there, so to speak.
Yeah, thanks, Bruce, for having me on here today. It is a bit of an odd jump to go from being a Marine Corps pilot to where I'm at today. So I'd love to share that with you in the audience. For me, it was 2012. I'm in Afghanistan for the second time, flying the V-22 Osprey and getting shot at quite a bit and having some pretty scary evenings and sometimes wondering whether we'd be making it home that night. So made some pretty fundamental life decisions at that point in my career. And one of them was to find a different way to make a living. And so I came back from that deployment, didn't know much, didn't have many resources, didn't really have any credit, so on and so forth. So I started wholesaling single family homes, and then that led to flipping single family homes. And then that led to wanting some passive residual income. I skipped a step there and went straight into buying mobile home parks. And we did that for a while and found that to be really successful, for really good investment strategy for us. We then moved into, Class C and D, pretty distressed multifamily apartments that were some heavy renovations, heavy value add there. And then 2020 rolled around and I got out of the Marine Corps and realized that I was getting a little bit wore out and tired of dealing with the evictions and the drug lords and all the things that come with, some work or not work for that come with, some of the lower class multifamily. I bought a motorhome, loaded up the family, went on like a 2-month trip as sort of a post Marine Corps celebration. Fell in love with it as a customer, and then that's when my eyes were open to this whole asset class that I saw. I had some familiarity with it and it started to make sense. And then I realized there was a big opportunity out there to take the lessons, the systems, the things that we had learned in multifamily investing and apply it to the outdoor hospitality world. So, long story short, we made a transition over a couple of years, and today we're now the owner operators of 14 parks and manage parks for other owners across the U.S.
Wow, that is quite a story. So I'm curious though, it sounds like you started investing while you're still in the Marines. How did that work?
I did. Yeah. So our first commercial deal was in 2015. I started flipping houses in 2012. I exited the Marine Corps from active duty in 2020. So for about 8 years, essentially, I had two full-time jobs. So it was a bit of a juggle. It was a lot of work. There's very little sleep, and but really was blessed and able to leverage that stability of the Marine Corps, stability of the government paycheck, and what that brought, and leverage that to be able to have a good launching point off into running our own investment company once that time came around.
So who's the we part of this group?
Well, me and my wife to start with,
Yeah.
and then I had a partner in Jeremy Hands, who we did some things together and some things as a company, and so we did most of the multifamily investing together to get to where we're at today.
Yeah. So now you have 14 RV parks and some you still have some multifamily apartment buildings.
We do. Yeah, we have just a few small boutique multifamily apartments. I think 67 total doors there, but the vast majority of our portfolio is RV parks.
So what is it? I mean, I know from going to Costa Noa, I don't know if you know that RV park out here, but
Mm-mm.
it's a kind of a combination of a hotel and a restaurant and an RV park and that sort of approach is. Can you describe some of your RV parks? Are they
Yeah.
strictly just pads and some restrooms?
Yeah, so most of our parks are a little bit above that and a little bit below what you described. So, I think probably most listeners or audience would recognize the KOA brand.
Mm, yeah.
That is very, very common to what our parks is. In fact, we just bought a KOA. Most of the time, we'll buy a KOA and then remove the branding or remove the franchise and put our own brand on top of it. So it's very much, we're not buying the super high-end resorts. We're not into the motor coach side of it, and we're also not buying the dirt pad
Right.
cornfield, essentially pasture parks, right? It's the very typical, most of our assets have a pool, they have a sports court, they have a clubhouse, they have an office, but likely not a restaurant and bar, right? So to us, that's a big delineation of what we would call a RV park versus an RV resort would be when a resort provides food and beverage, right? That's probably the next level up. So we certainly can manage those and have managed those, but we tend to like from an investment perspective to stay in that I would say top middle third.
Yeah. And so what areas are you mostly in?
Right now we're primarily in the southeast, so Florida, Georgia, Alabama, South Carolina, Tennessee, a little bit in Kentucky, and then we're moving west as we go.
Oh, that's interesting. So you do have sort of a plan to keep expanding, it sounds like.
Yeah, so it depends on the opportunities that presented to us, but certainly strategically, we like to stay, I would call it south of I-40, right? Essentially that freezing line that goes across the US. We're looking for parks that stay open all year. And, we're looking for business-friendly states. So the Southeast is good. Texas is a target for us. We have owned properties in Arizona. We did very well there. We enjoy that area. It's logistically a bit of a jump. So we're we're balancing both, the opportunities presented to us, the logistics of managing them there, and then as we grow, the logistics become less cumbersome.
So it sounds like you need a little bit of hands-on to these parks. When you get into Arizona, it gets a little too far away and you can't necessarily manage it quite as easily as you'd like.
Yeah, no, correct, right? So, it's still important to have ownership eyes on a property, no matter what, right? That's one of the lessons we learned, throughout our multifamily investing. One of them was that, we self-manage everything, right? We have our own management company, and in the RV space, it's really the only way to do it. There's very few management companies out there like ours. So in order to be a multi-park owner, you either have to have a solution like our management company or create your own, right? And so it's a big barrier to entry. And so yeah, so logistically, like getting to Arizona is a 2 or 3 day trip for me, vice versa, coming back, right? Did it make sense? Yes, we made a good return and a good amount of profit off of that deal, but the opportunity presented to sell it, it was an easier decision to sell that one because it just shrunk our travel logistics essentially.
Yeah. No, so that it sounds like, so what sort of metrics do you look for in terms of return?
For the park or for like our investors or what?
Yeah, well, that's an interesting question. You have investors with you, so
Mhm.
what sort of return are you sort of able to
Yeah,
give them?
yeah. From an underwriting perspective, right? We look to buy properties that we think can produce that upper teens, low 20s IRR. Right. IRR is our main metric. We are value investors, equity investors. So the parks do produce good cash flow and that's a benefit, but that's not our target. Our target is generally appreciation, wealth creation on the larger side. So in the past, we've done all of our RV parks we've sold. We've well exceeded those targets. And but that's our target, right? So if a property can't produce that, then it's sort of a deal stopper. Now, there's many properties that we buy that outperform that or outproduce it, but that's kind of the minimum threshold is we're looking for a high teen IRR for our investors.
So, just out of curiosity, are you looking for parks that need improvement, or are you looking for parks that just have a great income? What sort of metric do you look at?
Yeah, so there's two key metrics. One would be cap rate, just like any other multifamily asset or any other commercial asset. So we're looking at the cap rate, both in place, what we think we're going to achieve on the pro forma and the exit cap. And then I'm also a big proponent of putting guardrails on the NOI based off of a cost per site, right? Or just general basis. Um, and if I can build a park for less than what the park is being sold for, that's again for me kind of a deal killer. It doesn't really make sense for me to overpay for an asset that's older, that's in place that I could build it cheaper. Now, there of course is a real value to the time it took to get that park built, and the development process is hard and cumbersome, so on and so forth. But at the end of the day, there's kind of a price per pad range that I like to stay in, and that does tend to lead to the opportunities that are more value add, repositions, things that are poorly run or non-sophisticated owners, lack of systems that we like to buy, and then we can really improve the investment in the asset pretty quickly without a lot of, actual capex or physical improvements. It's an operating, it's a marketing type of improvement. So those are the best opportunities that we're looking for.
So that's interesting. So out of the current 14, how many of those have you built yourself?
We just one we built from the ground up. So the rest of them have been existing parks that we've bought and improved, or parks that we've bought and we have expanded them. Probably 50% of them we've added sites and added additional type of cabins or glamping sites and so on and so forth.
That's interesting. So a lot of times you look for sites that can potentially be increase the revenue by adding pads or whatever to the site.
Yeah. Yeah. So for us, it's kind of a 2 or 3 step process. First step, look at their marketing and online presence, fix that. Second, look at the current infrastructure, what perception upgrades or amenity upgrades can we do. And then the third step is actual, footprint expansion of adding more sites. So it's far easier to expand a park than it is to build a brand new one.
Yeah, I would think so. Absolutely. So you said you use a particular software called Homebooks. Is that correct? That's
Close, very,
you.
very
Yeah,
close. No, it's actually called New Book,
new
N-E-W,
book, new
New
book.
Book. Yep. That's our revenue management booking engine software.
So is that the only source you use for actual booking, or are there a bunch of different sites that you use that all kind of go into new book?
Yeah, so New Book syndicates out to I think 35-ish other OTAs, online travel agencies like what's one? Expedia. Right. So I don't know if it goes there, but I know it goes to hotels.com. So it goes out there and syndicates out to those. And and of course we have our own websites and things that are drive customers back to the booking engine. And then even if a customer calls us, right, we still a lot of people still use the phone. They'll call us, book a reservation, then we'll have to obviously manually put it into the reservation software there, being New Book to reserve that site.
So during COVID, obviously RV parks became very, very popular. How's the current trends working?
Yeah, so it did. 2021, 22 were amazing years for the industry. It certainly has come back down, right? So year over year, there is a decrease. However, if you went back and looked at the trend that we should be at, like go from 2010 to 2020, run a trend line out to 2025, we're at or above where we would want to be. So it's a bit of a perception, I think, right now that RV parks were a fad, and they were, and that now they're going downhill. They're just coming back to normal, which is where we really like to be. Predictability and normalcy in the market is really, I think, what most investors desire.
So there was kind of this big glut during the COVID, and then it kind of dropped off a little bit, and now you're sort of back to this steady
Yeah,
increase.
yeah, exactly. Right, we're back to that trend line. We look at unit sales from the manufacturers as a good marker, and you saw the same thing. We're back to what would be a very, very normal unit sales, about 430,000 to 450,000 New units were sold last year, and they're on track to do the same this year with a slight increase year over year. So that is very much a great indicator of where the industry is.
Yeah, no, that sounds like a fantastic area to kind of at least know what's happening out there in the marketplace. So I assume you haven't gotten into the RV sales side of the equation.
No, no, that's a whole different beast. We're
Don't want to go
we're
there.
No, I don't think I want to go there. Like I've owned a restaurant. I've learned my lesson on some of these types of business. So RV dealership and sales probably is not too dissimilar to a restaurant.
Oh,
They they are much more they are much more sensitive to the market, um, the economy. Whereas we're as a park owner, we're actually pretty insulated from the global market, even the U.S. economics.
so what happens in an eviction situation with an RV? I that
Yeah,
anyway, I-
that's a great question.
same as
Uh,
an apartment. What happens?
No, no. Of course, it varies state by state and county by county.
Um,
But that's one of the reasons that I kind of, quite honestly, got away from the multifamily investing was in 2020, yeah, of July of 2020, we bought a 167 unit Class C apartment complex. And typically we go through that and we would renovate it and clean house, both from a tenant base and from a physical base. And when the eviction moratorium came in and did all these things, right, that it crushed us. It was a really miserable experience, and we had we just was this constant cycle you could never get out of, right? If you don't have
right.
good tenants, you can't get good tenants, and you can't. So that was it was a painful experience for us, and we learned a lot of lessons, and that's what's very attractive to this space is at the end of the day, we don't have residents. Like this is not a home.
Mhm.
This is you are a guest, and we treat you like a guest. There's a hospitality component, but you don't have homeowner rights. So we, I think we're running close to 3,000 sites right now, and in the last year, I cannot think of one instance where we've had to um, do a quote unquote eviction, right? It's a
Really?
generally you're asked to leave. If you don't, there's more of a trespassing type of a
Wow.
conversation than there is an eviction. Um, so yeah, that's a big benefit of what we do, and one of the reasons we love this is that people want to be here, and if they don't, they just kind of leave.
Interesting. Wow. So if somebody stops paying rent, you basically say, see you later.
So yeah,
Hook up your trailer or whatever, turn on your engine and get out, basically.
yeah. So if we
And
have to, we can even help you move it.
so what happens in that situation? You move it to some other location or who knows, right? Yeah. All right. Well,
I'll plead the
doesn't
fifth
sound
on
like
that
that
one.
happens all that often. So,
No, it really doesn't. Like it's just such a cool community. It's people take care of each other and they also police each other well. So if there's a member of the community that's not there's a lot of peer pressure that can be
oh,
used because
that's
people
interesting.
want to create their own. They're creating a great atmosphere and they don't want that ruined by a bad actor.
So if somebody's playing music too loud or, you know, making a fire
Mhm.
too big or whatever, people will come in and kind of self-manage that.
Yeah, I know. I don't know if there's any such thing as a fire too big in a campground. Um,
Oh,
from my perspective, there certainly is, but maybe not from the guest perspective. But yeah, there's a very formal and informal kind of code of conduct in a park that people generally adhere to and generally police themselves to.
wow. So in the situation where you do have to call the police, did they come? I mean, they may be pretty far away, right?
Yeah. Again, this goes back to I think the starting thesis of our investment. We're generally, right, we operate in states that are very pro pro landlord, pro business, um, conservative states for the most part, right? So it's just quite honestly, it's not something that hardly ever comes up anymore. We don't
Wow.
discuss it, we don't think about it. It's just a non-issue. We ask you to leave, people are expected to leave, and if they don't, then Usually just the threat of calling the police is enough. It's very,
Wow.
very rare.
But this is very intriguing to me that there basically is sort of a code of conduct with this whole community, and they understand each other and know that they're kind
Mhm.
of living together in this kind of quasi nomadic lifestyle.
Yeah.
And well, I'm thinking back Costa Noa, which is the local place that we go occasionally, has all the different levels from tent sites up to RV sites and restaurant and lodge and so forth. So it's a little what you describe as the sort of luxury resort type. I don't, they have a pool anyway, regardless. But it's more of a resort feeling. But now that you mention this sort of code of contact, I mean, I can understand where that all kind of comes from.
Yeah, you probably felt it, and now you look back, and when you go there, you'll see it again. Like,
Yeah,
that you shouldn't walk through someone's site, right?
right, right. Yeah,
There's no rule up there. There's no sign that says, please don't walk through someone's site. And it's just a big grass area. And it's probably a lot quicker and easier, but you feel uncomfortable walking. There's a lot of this, it's implied. This is the illustration, I guess, or you see Jeep people. Every time people in a Jeep pass each other, they got the wave, or a Harley Davidson or
yeah,
motorcycles. It's the
yeah.
same thing, right? It's a subculture that has its own little culture rules. Now, it's not rigid, but it's there and everyone kind of feels it and understands it.
Yeah, and it gen well, I guess there is sort of there's the higher echelon people with the big 100, $200,000 RVs, and then there's the group that, has a car and a tent. But
Right.
still, they all sort of function in the same category, at least
Yeah.
kind of with each other. So that's interesting. I'm very intrigued by this. So
Yeah.
anyway, well,
Yeah. It's what it attracted me to the industry was I liked it as a guest. It's something that I can do with my family. Like I never took my family and went and hung out at our mobile home park or our apartment complex.
right,
But even
right.
even the worst RV park, I still can bring my family and I'm working, they're there. You know, our guests want to be there. They pay before they get there. There's no evictions, right? There's just so many things that I love about it. And like a mobile home park, I don't own really anything besides the dirt and the utilities. So there's not fixing the toilets and the roofs and all that stuff. Like the guests bring it and then they leave with it. And I make the same revenue per site as probably a comparable class C or B apartment
Okay.
complexes would be in the same city.
Well, that actually leads me to another question. Is the pricing of RV parks starting to go up? What's happening with the those kind of trends?
You mean like the sales price of the park itself or what the guests
Well,
pay?
that's an interesting question also, but I was thinking more of the cost per night fee.
Yeah, yeah, that certainly has increased a good amount from what it used to be. So, our average park is runs somewhere around the 60 to $90 a night. Um, and what used to be, I don't know how far back I could go, but a state park used to be maybe 10 or $15. And the
Right, right.
state and federal parks are now like 30 to $45.
Oh
And
yeah.
they may only get, power or water and power, or a full hookup site on the private side is the standard. So yeah, the prices have certainly ticked up, but it's still about a third the cost
Mm.
that the equivalent hotel stay or vacation would be based off of, you know, lodging and food and whatnot.
And so I assume that also has driven up the cost of buying a park.
Yeah, over the for this decade for sure, 2020 to present, there was the boom of the demand from the customers, which obviously drove up the revenue, which drove up the interest, and then the counter side of that of the distress that's happening in the multifamily space from over leverage and whatnot, was driving a lot of the multifamily investors into the space and thinking that they could do the same thing there. So there's definitely a bubble there and a bit of a glut. Prices are now, or in regards to cap rates, are certainly coming back down, or the cap rates going up, I guess would be a better way to say it.
Right, right.
Yeah, so now is a pretty good opportunity for us. We've closed 3 deals in the last 90 days. In 2024, we basically bought no deals. So we're seeing the cap rates come down to where they should be, expectations getting much more reasonable, and for lack of better words, that the fire has burned off the chaff of wannabe investors and people who thought that this was going to be the an easy home run. It's not easy.
Yeah, you know all too well.
Yeah.
So, uh, so what are you financing these transactions? What are you doing on that side?
Yeah, so our typical structure is somewhere around a 65% leverage. That would come from sometimes seller financing is a fairly common
Yeah.
uh, debt form in this space, but we use a lot of regional banks, credit unions. It's a creative mix. There's two big barriers to entry to coming into this space from an investment perspective, and that's debt. There's really no institutional level Fannie Mae, Freddie Mac type of
Um,
product. So it's constantly working and negotiating with local lenders. And then the other big barrier to entry is the management, is the execution side. It's very management intensive. So that allows the cap rates to stay high and allows the returns to stay high. So if you can solve those, then there's a lot of opportunity. But this is not a like a raise capital, hire a property management company, get non-recourse debt, sit back and go. That's not this.
not that's not what's going to happen here. Well, I assume
No.
you have to have one or two managers on each property.
Yeah, yeah. So typically, staffing can vary from size of park and seasonality even, but we always have a general manager at each property. Most of them actually live on site full time, which is really nice. And then there's going to be maintenance and staff, and then some parks maybe uh, have two people, some maybe have 15 or 20. So it totally depends on that park and what's happening there.
Do they live in an RV usually, or do they have a house on site?
Both. Yeah, a lot of our parks comes with a house, and a lot of parks our managers are full-time RVers, and they stay
Well,
on the park with their own rig.
well, this is very intriguing to me. This is a whole new world for me to understand, and I'm sure that's probably true of a lot of listeners here. So,
Yeah,
where in the world, Robert, would they find you?
probably on the road in my RV. Um, yeah, so you can find us online for sure at climbcapital.com is our investment company. And unhitchedrv.com is our brand and where you can go to book campground. And so, of course, my email is robert at Climb Capital or robert at unhitchedrv.com.
Well, I look forward to talking to you again in 6 to 12 months because this sounds like a very interesting process that you're going through in terms of growing your business. So,
Yep.
good luck with that, and I look forward to talking to you again in the future.
Thanks, Bruce. Thanks for having me.
Talk to you soon.
That's a wrap on today's journey through the SF commercial real estate scene. Ready to share your story? Visit sfcommercialconversations.com/guest. Your insights could lead the next conversation.